Sorry about that, folks. Waiting for my microphone to kick in. Looks like it's working. Good morning, everyone. Welcome to another Strategy of the Day update. I'm Dan Hussey. It's April 9th, 2021. Remember, trading futures involves risk and is not suitable for all investors. And everything we talk about here today is just my own opinion and not a direct trade recommendation. Going to begin talking about December corn and November beans here and some of the overnight price action. Not much to really update on since yesterday's video. December corn still very much in its sideways range. The failure to break back above 560 and even get a test of it last night, it doesn't really swing me one way or the other. But again, the more time we spend in this range without breaking out, without going up to fill the 580 gaps and all those good levels above us that we talked about, the larger probability I see of some kind of move, technical move to the downside or flush out of funds and what have you. That capitulation that we'd love to see for the market to then really rally off of, built on the back of strong demand, could be around the corner. The U.S. dollar here is a little bit stronger today, with the Dixie going and making a new higher high and higher low for the day, continuing its trend since the start of August, now higher for a test of that 93 area. Talked about yesterday, not much in the way of this market pushing back above the 93 figure and seeing some dollar strength. Now that we've seen a golden cross with the 55-day above the 100-day, the 100-day above the 200-day, and now the whole market above that 18-day moving average, to me suggests that the dollar index is very likely on its way back to test some resistance, or maybe a 50% level of this entire decline that we had since March of 2020. Again, resistance is very likely up somewhere above 94. Had a cluster of highs there back in October of 2020. Lows there from June of last year and March of last year as well, between the 96 and the 95 area. We'll see what happens on a test here of 93 to 94, though. And again, not really into any kind of overbought condition in the stochastics there, so probably some more upside. Got to go with the short-term trend here with a dollar higher. That's going to weigh on our export markets, even though today we saw another positive sign coming out of China with another flash sale of over 100,000 metric tons. We've had over 500,000 metric tons of soybeans sold here over the last week, I guess 5-6 days of trade. But with a rising U.S. dollar, I wouldn't be shocked to see this just being some tests and, putting the toe in the water and testing where the market's at and what kind of positivity it might bring to the market. So not much in the way of the technicals there. Corn inside day finding its way right back to 555 and hovering there inside of a tight trading range that at some point here is going to break. We'll come back to corn because I do want to look at the December 2022 1 to 2022 corn spread. I think that there's some interesting dynamics building there, but we'll get to that in a minute. Soybeans, higher highs and higher lows for the third day in a row here. Certainly began somewhat of a trend off of its lows. Very choppy, but yet constructive price action is forming off of that 1308 test and lows of the month of July. Certainly, you make a case for trading higher here inside of some kind of short-term channel. And with trendline support coming in and holding this morning right on cue at the 1228 area, but coming back down to test there. Not a great look for the market given the very choppy overlapping structure, although progressive to the upside with higher highs and higher lows. The open gap at 1352 has remained to be filled. There's also channel and trendline resistance up there at 1350, so maybe 1350 quarter, leaving that open gap and a failure to fill it today. A break below lows of the day, certainly below lows of Friday at 1323, in my opinion, would recall a test of that $13 level and might actually be a sign that this market has in fact started a downtrend, has rolled over, and could be heading down to a test of the 1240 lows from June, or even below there into those larger supportive levels that we talked about yesterday. Do check out that video for more details on the daily and 4-hour charts there for both November beans and December corn. But today, and the reason I wanted to hop into talking about our spread markets is we had some questions from yesterday's video, and a great point being made. Take a look, Dan, at December 22 corn, because it is impressive the rally we've seen there. However, Spread markets are funny. Is that the tail doesn't usually wag the dog. It's usually the other way around. The dog being your front month futures and the tail being your deferred month contracts. And there's probably a dynamic going on of now building carry into these markets that we haven't seen for several months. And as we take a look here in a minute at the actual chart of spread price action, I'll show you how that kind of breaks down. And we'll also take a look at the futures curves and how they've changed over the last 3 weeks. But to start, let's take a look at the cost of carry table here for corn. Our December corn contract I've highlighted here. You can look very quickly at, if you've never looked at a cost of carry, table, it very quickly tells the trader where the futures market is in terms of two situations, either contango or backwardization, normal markets or inverted market conditions. Inverted market conditions, which we pretty much see across the board for our row crops, are indications of diminishing supplies, strong demand, and a carryout where we are effectively left worried worried about running out of our commodity. So traders and commercial interests are willing to pay now and pay up for that commodity to have it physically delivered for them now, being worried that it won't be there in the future. Normal markets or contango are where we build into a carry trade where markets are more inclined to actually store the commodity, and they seek that cost of storage out of the price of a commodity for its storage into the future. So, for example, the cost of storage between December 21 and December 22 is calculated out as a cost of carry of $1.18. Let's just call it $1.19 because it's round up there. So it'll cost you $1.19 at the exchange traded spread, or the exchange rates for carry to storage a commodity for delivery in December of 22 if you put it there for storage at December of 21. That $1.18 carry, it would be represented on a spread chart, as we'll look in a minute, as $1.18 under. And with the spread market for December 21 to December 22 corn trading at 36 cents over, and that over and under is a threshold is indicative of where even money or the 0 point is. In other words, when they're at parity is how we refer to it. So at $1.18 under, the spread market at 36 cents over right now has a considerable way to drop before it would be at full carry, or where the market could literally arbitrage out the cost of carry between these. In other words, if our spread between 21 December corn and 22 December corn were to fall all the way down to $1.20, you could, in theory, buy the futures for December 21, take delivery of them, and retender for delivery to December 22, being paid by the market $1.20 to do so, and capture out a penny and a quarter of free money, if you will. Obviously, it's not doesn't work out that way. There's costs of delivery, costs of retendering, and of course costs of transactions involved in the middle. However, it's very unlikely for the markets to trade below their full carry levels for very long, because the market can literally arbitrage out that cost and make free money for storing the commodity over that time frame. The current condition of the market, and let's take a look at what December, because we did just look at December 21 corn, very sideways. I guess I'll bring that chart up again here just for a minute. Really going absolutely nowhere. Has not broken out of trendline resistances, hasn't filled gaps above. There's no indication of a directional trade for December 21 corn right now. We definitely are building in some kind of fundamental story behind weather markets and where potential future demand could be. We know China's national stockpiles of corn have pretty much been diminished, or have been, as reported by Reuters. And we would anticipate some strong corn demand out of China to replenish those stockpiles. Now, it's obviously hasn't happened via our export markets just yet. We're on pace for our export season, but a lot of that is due to purchasing out of Mexico. Corn futures have been unwilling to break above key technical levels in the near term, been unable to hold and price sustain above $6, and that's where the discussions of potentially destroying some demand in the near term might be occurring. So in order to bring that demand back, price just needs to fall, either in the value of the US dollar falling relative to our export trading partners' currencies, and the dollar falls, they have more purchasing power, so it doesn't really matter where the price of corn is valued in US dollars. However, if the price of corn valued in US dollars were to fall, it would very likely attract those export partners back. So what we're seeing, though, is that in the December 22 corn, a very different story is being told on the futures board. We are, in fact, breaking out of the technical ranges that we've been holding. And actually, ever since the start of August, this market has been inclined to build carry back into December 22 corn. December 22 corn was fighting to break above the $5 handle. Now it seems that the market is very comfortable bringing the price of December 22 corn back above $5, and now pushing it in theory closer to parity with December 21 corn. This isn't indicative, in my opinion, of a market that is getting ready to break out towards $6 corn. This is indicative of a market that is being bear spread, and the futures bidding that is going on in December 22 corn is relative to the bear spreading we're seeing in December 21 to December 22 corn, indicating carry being built into these markets, which is not a bullish long-term indication. It's certainly great to see that December 22 corn wants to price above $5, but it's more likely because we're trying to now attract that carry and that cost of storage back into the market rather than price appreciation based off of supply and demand elements going on. So that doesn't mean, though, for a second that we don't have an uptrend for December 22 corn going on. We absolutely do. We've made higher highs and higher lows now for the entire month. That is a huge move. And we are now solidly above $5 and probably going to stay there until some major breakdown happens in our front month futures curves. And those futures curves we'll take a look at just a minute. Coming up on trendline resistance here at 520 for December 22 corn. Interesting level to see if it will break above. And I think breaking above that level will very likely coincide with our spread market. So let's take a look now at that spread that we're talking about. Ignore for a second the purple and the blue line. The blue line is our December 21 corn. The purple line is our December 22 corn. I have these overlaid right now to try to show you how it's the tail doesn't wag the dog here. The dog wags the tail. The tail being December 22 corn, the dog being December 21 corn. And you can see how in this spread, there's a much tighter correlation between December 21 corn and this spread than December 22 corn in the spread, although they all move relatively together. You can see over the last week and since the start of August right here, the two seem to have separated in terms of where they're going. And that is, in my opinion, more indicative of the bear spreading that we've seen now in this December 21 to December 22 spread, which is the actual bar chart, the bars or the candles, excuse me, on this chart of red and green. And being at its low here for the month, trading to that low today, is, in my opinion, a good reason why that carry is being built in the market. December 22 corn is allowed to rally, while December 21 corn stays put in its range very comfortably, not being affected by export demand because there isn't much, but also not willing to sell off because weather markets are still at play here. And we have that tale of two corn belts going on in the United States where it is such a stark difference between our eastern and western corn belt that it's very hard for the trade to get a good reading here. The fact that we got Pro Farmer Crop Tour coming up next week, we got a USDA WASDE report this Thursday, all to me indicate this market is perfectly comfortable sitting still until we see results from both the WASDE and the Pro Farmer Crop Tour come back before it starts pricing one way or the other. However, the carry market is not saying that. It is perfectly happy building carry out into December 22 corn, which might make it a better buy in the short term, given the bear spreading we're seeing on the board today. There is a clear supportive area here between 40 cents over and 30 cents over in December 22 corn. This is, the corn spread, 21 to 22. These levels correlate with the low end of the range that we saw in both outright corn futures, and failure to break below or holding support on the spread chart at this level is very likely going to keep December 22 corn from being able to rally too much above 520, break out above its highs and come to parity with December 21 corn, certainly before we get some of these big news events and the Pro Farmer Tour out of the way here in the next couple weeks. So if we do continue to see bear spreading here in the 21 to 22 contract, It's my opinion that we'll very likely then free this market up to go down to test towards parity or that zero mark, even money, in return to more normal conditions. December, and of course be indicative of a carry market that is usually a little more bearish when you consider the outright futures. So that being said, let's take a look at the change here over the last couple weeks. The red line in this futures curve is very simply the price of each, and won't make it percentage here. There you go. The price of each futures contract going out into the future. So you've got your September contract here priced at 550.75 on the day. You've got your December 21 contract, the first one we really care about, or we've been discussing, trading at 552 3/4. And then, we have carry built out through next July, so through our next marketing year, right? And you can already see that, March corn trading at 560, May corn trading at 565, with the July corn trading at 566. The market is already trading back to out of an inverted territory where we're afraid of that supply not being there in the future, so willing to pay up for it. In other words, we'd expect December 21 corn to be above these levels. But what we have is, effectively going out on our curve through this marketing year, July 22 corn at an inversion to December 22 corn. That type of inversion at this point in the year it's got to be indicative that we're fearful of our crop, really fearful of our crop not being there this year, tightening that balance sheet down to a stock to usage ratio that is traditionally very tight, and then probably some kind of indication that we have a lot of faith in export demand and domestic demand to be there to continue to dwindle down that stockpile of corn, even weighed against what the future production for next year might be. So it's this time of year that we will oftentimes see this inversion get taken out of the market and start to build that carry in. And if we see that bear spreading in July 22 to July 22 Dece corn, as well as bear spreading in December 21 to December 22 corn, it's very likely that this type of inversion is going to be taken out of this market, and we will see July 22 corn fall further, faster, stronger relative to December 22. So that bid and building that carry out into the back is what we're starting to see. Now, I put up the red line is the current market price. The yellow line is where we were 1 week ago, and the blue line is where we were a month before that in mid-July. So many of these prices have risen since last July, but their relative change, you can see here over the last couple weeks, is starting to show itself. In other words, you can see here that the relative change between December corn relative to a month ago, a week ago, this is December 22 corn, and now you can see that we have risen considerably more than December 21 corn has, either compared to last week or a month ago or even July. You can see compared to a week ago, we have very little movement relative to these outright futures where they were a week ago. But a month ago, we can see a much bigger movement higher. And the fact that this December 22 corn is rallying further or continuing to get a bid under it while the rest of the market is either being bid less or not at all is exactly how we're getting the bear spreading going on in this spread. And let's remove these comparison studies here for just a hot second. I wanted to show how the blue and the red or the purple there, your December 21 to 22, had kind of gone off in their own, and that is indicative of the bear spreading going on and the trend lower we've seen on this chart. So a break below this 30 cents over area on December 22 to December 22 corn, to me, probably spells for this market to continue to build carry in. I wouldn't be shocked to see that bear spreading also drag December 21 corn down, and you'll start to see December 21 corn show negative days when December 22 might not show negative, or December 21 corn down 10 cents when December 22 corn is down a penny or not at all. Those are the types of market conditions and price action you'd expect to see in a bear spreading market, building carry, and starting to effectively roll that carry out into the future. So I hope this has answered everyone's questions, or maybe shed some more light as to why December 22 corn is rallying so hard here, or is is showing some favorable price action. Maybe it's breaking out. Could that be an indication that December corn this year is going to break out? I don't believe so. It's the tail that wags the dog, or the tail doesn't wag the dog. It's the other way around. So, want to discuss these ideas more? Get in touch with us over here at 312-277-0110. We're always here to talk marketing, risk management solutions, and how any of this plays out for a trade plan for you. You can find me on Twitter, Facebook, shoot me an email. Have a great day, everybody, and we'll be back with you as price action develops.